Hey traders, this is Blake Morrow with Trader Summit, and with me today is once again I have Mr. Marc Chandler for Bannockburn Forex. How are you, Marc? Good to see you.
Good to see you. It's always good to see you.
It's always great to see you, and it's really great to see you because we have this historic. I say historic, but we have the annual Jackson Hole Symposium, but kind of historic because it's kind of wedged between a couple big Fed meetings. So, what are you expecting this week out of the out of Jackson Hole?
I find the Federal Reserve difficult to forecast, but the market seems to be easier to forecast. And to me, what my forecast for the market would be is that no matter what Powell says, the market's going to see it as dovish. And I don't fully understand why. The Federal Reserve is engaged in a very aggressive tightening sequence here, perhaps, and we can talk about that, maybe the third 75 basis point hike in a row. They're on the verge of doubling the pace of QE. And there's people in the market who still say the Fed is dovish. And we see this repeatedly, even with like those FOMC minutes we saw. And so my sense would be this, that the real sector economic data is holding up fine, or relatively better than the survey data, and that the Federal Reserve is going to explain why they have to continue to tighten policy. And the market's going to read that to be dovish. And so I think that what we're doing is we're buying the dollar, which rose to new two-year highs against the Chinese currency today. It's risen to two-year highs against the euro, 20-year highs against the euro, two-year highs against sterling. And I think that we sort of buy the rumor, sell the fact. So that after Powell begins talking on Friday, I think the dollar comes off.
So, so what you're saying basically is no matter what the Fed chair says, the market's probably going to spin it as somewhat dovish. Is this maybe like a case of having some beer goggles in the market? Like the market just, wants to see through, like maybe see the end of this rate hike cycle come and just try to latch onto any dovish word he uses?
Yeah, I don't know. I think that because the Fed was like other central bankers and frankly, most of us market participants had underestimated inflation, the persistence of it, how high it got, how quick it got there. And so I think that maybe he's being punished for past sins that we're all sort of guilty of, I think, to some extent. Even people who have been the Fed's critics, like Lawrence Summers, he didn't expect inflation to be at these levels either. And so I wonder if it's, and on one hand, I'd say that the market just has this habit of reading him dovishly. On the other hand, I want to say there's a couple shifts that have taken place in the market that show a recognition of the Fed's anti-inflation credentials. For me, these would include that the market had been pricing in no rate hike next year. And now the market's pricing in almost 25 basis points in Q1. The market was also pricing in the middle of July. So we're talking about a little bit more than a month ago. The market was pricing 60 basis points of cuts next year. And how I get to this is I look at the December Fed funds futures for this year, compare the yield to the December Fed funds futures of next year. There was a 60 basis point gap 6 weeks ago. And now it's about 5 basis points now.
Wow.
And the other thing that I think that's happened, the third kind of shift on Fed views, is that the market has been kind of fickle about how much to expect at next month's meeting. And we were less than 50-50 in favor of 75 basis points. And now we're about 60%, 65% in favor of that 75 basis point hike. So all three ways, I think the market has recognized that, I want to say, come hell or high water, the Federal Reserve is going to be tightening policy like other central banks, despite clear signs the economy is slowing and perhaps even on some edge of a recession. And I say that not just in the U.S. after those 2 quarters of negative growth. I see the Atlanta Fed's talking about 1.4% GDP growth in Q3. But we saw that another dismal PMI. So it's really remarkable. The U.S., Japan, the Eurozone, Australia, all have the composite PMI readings below the 50 boom bust level. And I know the survey data has been much weaker than the real sector data, but I suspect that the real sector data is going to catch up, and the surveys, our ideas about things, are running ahead of the actual facts.
Well, so I'm assuming it doesn't surprise you then to see the dollar moving the way it's moved and seeing the euro, slump to 20-year lows, sterling to 2-year lows and whatnot. But are you surprised on how well the equity markets have been holding up?
Well, I'd say the equity markets have held up well, I guess. I mean, to me, it was a big bear market rally. I know some people tried to link it to Fed policy. I just don't see those things lining up very well. I just think that sometimes in a bear market, you can have a bounce that doesn't have any like big fundamental reason. Early in my career, back when such a long time ago, Gorbachev was the head of Russia, and he was visiting New York, and he got out of his car and he shook people's hands, and that turned the market around. Any logical reason? Probably not. But in some ways, I want to say that's what happened in the stock market. Now we had this bear market rally, and I think that it's over. And even though we might be holding up all right today, I think that to me, the Federal Reserve and most of the major central banks are making it clear they want to tighten financial conditions. So if you're trading financial assets and they're trying to tighten financial conditions, you know you got the wind in front of you. You got a big headwind coming to you. It's not that you can't make money. It's just that you've got these big force working against you.
Yeah, it's a great point. Well, we know that the Jackson Hole Symposium is not all about the Fed chairman, although everybody's going to be focused at Friday morning at 10 a.m. Eastern. Everybody's going to be hanging on to every word that he says. But are there any other central banks that are going to be any other central bankers that are going to be speaking that you're going to be paying attention to, or is it really just the Fed show?
Yeah, so you're right. I think that there's other central bankers around the world are going to be there, but I think like the Fed, the market has come around to. So we had this very poor PMI data from the Eurozone, second month below that 50 boom bust level. And the market says not only will the ECB hike by 50 basis points next month, but there's about a 1 in 4 chance or a 1 in 5 chance they go 75 basis points. And the Japanese have this. Japan's in a tough position in a way. Inflation has been above their target for several months now, and yet they still insist, like we did earlier on in the crisis, that inflation is only be temporary. Partly because a lot of these central bankers see inflation as just a function of wage growth. And because wages aren't growing very rapidly in Japan, they say we can't have high inflation. But lo and behold, they do have high inflation. But I don't think that this is going to be the forum in which Bank of Japan Governor Kuroda announces a change in policy. I think that for a foreign central banker to come to the U.S. and to announce a change on our soil doesn't seem like politically correct to do. So I think that mostly what they're going to do is talk in abstractions and reiterate their commitment to fight inflation, but not really signal a change, a deviation from their current path. So that means the ECB is going to hike, most likely 50 basis points. The Bank of England next month also likely 50 basis points, maybe 75 basis points, even though they are one of the first central banks to forecast I think it's a 5-quarter recession beginning later this year. Right. That's their forecast, and they still want to raise interest rates. And I think that the central bankers around the world were sort of caught behind the curve and are now trying to play catch up and trying to convince the market that they're serious about inflation. And the way to do that, I think, is to deliver what they've signaled to the market through their forward guidance, what the market's expecting. Anything dovish, I think you'd see a much more surprising and dramatic market reaction.
So, Mark, let me ask you this, because the dollar is obviously on a rampage. I mean, here we are, at 20 some odd year highs. The dollar index is trading, well above 107 or 109, getting close to 109, 110. What would turn the dollar? I mean, is it going to be where the US, or excuse me, traders and investors finally figure that the US has come towards the end of their hiking cycle, but they still feel that other central banks, such as Bank of Japan, such as the ECB, such as the Bank of England, have to continue to play catch up? Do you think that is what turns the ship of the strong US dollar that we've seen eventually?
Yeah, eventually. So I'll tell you what I'm watching. So we've had a couple of these big dollar rallies in the past. And so I'm looking at the things what's characteristic of the late cycle dollar rally. And to me, what I'm watching is the US German 2-year interest rate differential. And typically I find that 2-year interest rate differential peaks before the currency does. And there seems to be a narrative around it. Because at first, right, you say well, we need to have a high interest rate to attract us into the dollar, given a budget deficit and trade deficit and whatnot. And after a while, when the dollar is getting stronger, you realize that maybe you don't need to have such a great return on the underlying asset because the dollar is your kicker. And then at some point, so you accept a narrower interest rate differential and you're still long the dollar until one day the market realizes, whoa, we're not getting paid any longer. We're not getting paid as much to be long the dollar, and it begins falling. And so I'm watching that U.S. German 2-year interest rate differential closely. I thought we peaked earlier this year. I thought we peaked in the summer, but earlier this summer. But we made a new high last month. But now we're coming off more sharply as European rates rise quicker than the U.S. rates.
Yeah.
So, I mean, I think it's one of these things, from a trading perspective, right, that there's sometimes a windows of opportunity. And I think there's another window of opportunity here where the dollar might be, we get this other sort of blow off top where everybody and their mother is long the U.S. dollar. And we all come up with all these great reasons why we need to be long the dollar, how bad the rest of the world is, the driest towel on the rack, the least ugly in the ugly contest, all these kinds of images. And I think that, to me, that's another sign that of sort of that late cycle when people say there's no alternative to the dollar. The dollar is king again. And I think that's sort of part of the psychology that lets these interest rate differentials kick in. And so I'd be looking for still a stronger U.S. dollar. I don't want to fight this yet. Market's not as overextended as one might think, given how strong the rally's been. I'm looking at things like the slow stochastics, the MACDs, even those Bollinger Bands. We touch them a little bit, we consolidate around them, and then we continue the advance. So I think it's a bit early right now to pick a dollar top, but I'm looking to do that. I just want to have these like the stars line up, and they're not quite in alignment yet.
That makes a lot of sense. Well, Mark, I want to ask just one last question, because last night, now I know people are going to be watching this either the day before the Jackson Hole, which would be tomorrow, or possibly early in the morning, just before in European trade, just before the Fed chairman comes on and he starts speaking. It starts his speech. But last night we got some very hawkish comments from Neil Kashkari, even though he's not a voting member. He does, put his dot plot on the dot plots. And I guess the question is, he was pretty hawkish, but how close attention do we have to be paying to all of these Fed governors, regional Fed governors, especially knowing that the market is just expecting the Fed to continue to raise rates? Is it that important at this point in time?
Well, I pay attention to what officials say, not always because of what they mean, but also sometimes what they're not saying. But I think when it comes to people like Kashkari and trying to evaluate the Fed, I see a lot of people who are still like in this sort of a binary mode of hawks and doves. Yeah. And I think that many people are caught off guard, not just now by Kashkari, but I think a week or 2 weeks ago, he admitted that it was his dot that was the most hawkish in June, as far as where Fed funds ought to be. And I think he was there 3.9% for the end of this year. And I think that rather than just think about hawks and doves, we've seen this in other central banks as well. A guy who just term was just over at the Bank of England, Saunders, who was sort of the external member to the Bank of England. He's what I'd call an activist. And same thing with Kashkari. What I mean by that is that back in 2017, when Kashkari first got his post, he dissented from every Fed rate hike. So people thought he was a dove. And now he says he's the most hawkish, more hawkish than St. Louis Fed Bullard. And I think that's what I mean by activist, is that he thinks that the central bank has a big role to play. And when they're easing, they're going to have to be very easing. And when they're tightening, they should be very aggressive in tightening. And the same thing that Saunders did, he would dissent sometimes in both directions in a matter of a cycle. And so I think that pigeonhole, of course, as analytics skills, we need to put people into pigeonholes, right? He's a hawk, he's a dove, or she's a hawk. And instead, I think that helps to just take a step back and think about not just this binary system, but how people are activists and how people want to lead the market in both directions. And so I do pay attention to what the Fed says. And I think that in a rising interest rate environment, it makes sense to pay attention to the hawks. They're leading this move. I mean, whether it's Bullard or Kashkari, I think that they've been among the most aggressive. And so I think it makes sense to pay attention to them. I just don't think that they are always representative of the Federal Reserve. And so I think that I still would say Chairman Powell is the chair, and he sort of gets the benefit of the doubt, which means that I give his views the most credence. And after that, I think that the others sort of sort themselves out. When a hawk like Bullard talks hawkishly, so what? No big deal. It's sort of as expected. It's when they change their views, even subtle views, like, for example, Kansas City Fed President George. She dissented from that 75 basis point rate hike, the first one, because she thought that the Federal Reserve had signaled they were only going to do 50. And it's better for the Fed to be sort of true to its forward guidance than to surprise the market. But she favored 75 basis points in July. And it's hard to say that a 50 basis point rate hike means that she's a dove. So I think that paying attention to some of these nuances adds color to the story. But ultimately, I think, and we see this from the lack of really dissents at the Fed, that they are reading from the same page. They want to make sure that the central bank has the anti-inflation credentials. And I think that we're going to have a problem down the road because we have to begin thinking the trade-off of getting inflation down to 2% again. At what cost does that come? But I don't think we're there yet. I think we're still on raising rates. Whether we get up to 4% or not sure. I thought the Fed would be done at the end of this year. And I thought that by this time they'd be breaking something. And we still have a quarter to go. They still could break something. When I say break something, I don't mean just the housing market, highly interest rate sensitive, horrible numbers in this past week or so. I mean, it's got to really affect consumption and the labor market. And so far, next week we get we get Powell this Friday, and the following Friday, the next Friday, we get the non-farm payroll number, and the early call looks to be around 300,000, which is down from about 530,000 previously, but 300,000 is still a solid number. It's a number that's going to encourage the Federal Reserve that the market is strong enough, the economy is strong enough to withstand more pain.
Interesting. It's always interesting to meet with you, Mark, because you really make us think about everything that's happening, especially over the next couple of days, but even moving forward. And I know I'm speaking, on behalf of the Trader Summit community. I really appreciate your thoughts and your ideas. As a matter of fact, if you're watching Mark on YouTube right now, make sure you give him a thumbs up, subscribe to the channel so you don't miss any of this exclusive content. But Mark, how do we follow more of your work, more than just these videos?
Well, yeah, thanks. I mean, you guys post my daily comment, and the amazing thing is I've been able to, for most of my career, been able to, especially in the last like 20 years or so, be able to work for employers who allow me to have a social media presence. So I can post my things. I know a lot of people have to charge for their newsletters because it's hard work. The amount of time we have to do these things. And I'm fortunate that my employer pays me. We could debate about whether he pays me well or not, but he pays me, which means I don't have to charge for my commentary and analysis. And so I post it free on my blog, Mark to Market. I try to keep my Twitter going. My handle there is Mark Making Sense, which really comes from my first book called Making Sense of the Dollar, which is just really a review of sort of 20 years in the industry at that point, and how I thought about the dollar, the foreign exchange market, and why I thought there were myths. I try to identify like 10 myths that I think are just myths, so I try to poke holes in them. But my DM is always open. People want to direct message me. I really, what amazes me on the social media is people like cut each other off and mute each other and block each other. And I find that I learn more probably from people who disagree with me than agree with me. So disagreeing with me is a way for me to be learning. And so how can I cut somebody off for giving me a free education? And so I'm always open to, and it's always done with the most respectful. If I disagree with someone, I think that's the highest respect I can pay them, is that I take their ideas seriously. And so, of course, respectfully, but taking people's ideas seriously and pushing back against them, I think it's a great part of the learning process for me. And so feel free, whether you agree with me or not, you can follow me on Twitter, follow me on my blog, and you guys post my stuff, and I appreciate that, because I think that in this world that we live in, it's not scarcity that really is a source of value. The value of I use Microsoft Outlook, what my work does, and what makes that valuable is I can email anybody in the world. And the same thing with the social media, that what makes it valuable is that I can participate in the dialogue even with people that I don't really know or who don't know me. And so I appreciate you for posting my stuff and letting a wider community take a look at it.
Well, we love having it, Mark, and I got to say I'm with you, and I'm going to be in agreement with you this next couple of days, because I'm going to probably be buying the dollar. I'll be at least selling the rumor after Friday. So thanks for joining us today, and I can't wait till our next meeting.
Good luck.
Thanks. Good luck to you. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.